What if the real estate market flipped overnight? With Trump now in office, shifts in spending, taxes, tariffs, and regulations could reshape everything, creating both risk and opportunity. Will tax cuts actually help drive higher returns? Will tariffs drive up costs? Could deregulation and efficiency in government spending spark a boom or a crash? Today, we're going to be breaking down exactly what's changing, what's coming down the pipe, and the key moves investors need to do now in order to stay ahead. Now, if you're interested in investing in real estate and you can't find any good deals, or you don't have the time to do all the work, we are getting closer to our next apartment acquisition. And if you're interested in learning more, go to ferriscapitalpartners.com to see how we're partnering with investors like you to get 20% annual returns plus monthly cash flow with our team doing all the work. John, it's great to be here with you.
Great to be here too, Mark. This is a big topic, right? A lot of news. Trump's been in office for a few weeks now. So there's just been a flurry of new sort of approaches, right? And I think for me, number one, this isn't really a political conversation, right? We're not getting into like, the right versus the left. It's really about just what to expect and how could this impact real estate. And I think one key factor here is Trump is a real estate guy, right? That's where he made his wealth. And so he loves and believes in real estate. So despite your politics, we're really going to hammer into what we expect from the Trump administration and how it could impact investors' returns. So, a lot to cover, but we're going to go through it pretty rapid fire. And that just goes back to at ferriscapitalpartners.com. You can just book in that call if you want to talk about topics like this, investment strategies, or to learn more about some of our deals we're working on. Always available.
For sure. You had said he's a real estate guy and he's also a business guy as well. And so if you look at the last term that Trump served at, you saw property values increase by 18%. So, past, we'll say past numbers doesn't always mean that future numbers are going to be the same. But that being said, real estate guy, business guy. And so we're going to be diving into some of the things that are actually happening now that can actually impact real estate. And so that is really important is look at, okay, what is happening now, what's coming down the pipe in order for us to, better, better prepare and make quality wise decisions.
That's right. And even within the first few weeks, we saw REITs, real estate investment trusts. For those that aren't familiar with that acronym, that's where an investment and fund will, pull together a number of commercial real estate assets. Some specialize in certain asset class, some diversify across. Many of them, and so REITs have seen gains, right? So that's in investors, in the marketplace betting on positive signs in the real estate world. Now the Dow has fluctuated a little bit, but a lot of that's been driven by some weird news out of China with their sort of new AI, and it just goes back to Mark why I like real estate as an investment vehicle because it's a lot more predictable than the public markets, right? China releases a new AI and $1 trillion is erased from tech stocks overnight. And so, but that all said, when you're looking at the performance of real estate stocks, we've seen some positive movements. So the investment marketplace is looking at what's happening and saying we like what we're seeing. So, a couple of things I thought would be worth noting too. You mentioned kind of under Trump's first 4-year term, one of the things Trump put into place during that term is something called an opportunity zone. And so, for our Canadian listeners, an opportunity zone was effectively where they went into markets where, maybe Atlanta is a great example, and they identified little pockets that maybe were industrial and underutilized. So areas that could use some revitalization, in other words. And so what they did was they created incentives for owners and operators and investors to invest in those markets. That program is set to sunset, but the common thought is that will now be extended and actually potentially even expanded. And so I actually am invested in a couple of opportunity zones. So it's interesting, Mark. It's markets like in Portland, Oregon. You wouldn't necessarily think, oh, Portland, Oregon, it's a big market, but there's a lot of pockets that could use that development. Another one I'm invested in is in Colorado Springs. So it's a new thing under Trump. There was this idea that the Democrats would let it sunset. We think they'll expand understand it. Now, we don't do opportunity zones. They're 10-year holds. They're a lot more complex, but it just speaks to some of the things we expect. And once again, those are real estate friendly decisions. So we're really excited for some of these things that are coming. Now, on the other side of it, there are some things that have already happened or that have been mentioned that could have potentially some downside to residential real estate investing or really just commercial real estate investing. And the number one mark is tariffs, right? So let's talk a little bit about tariffs.
Yeah, so I mean, if you go to Canada right now, I mean, the Canadians are, I'm speaking from experience. We run a real estate team north of Toronto, and so there's a lot of uncertainty up there right now. And John, like, not a fan in regards to what happened at the hockey game. There was a national game
Yeah,
with the U.S. and in Canada, and a lot of the Canadians were booing the U.S. hockey players. So it's
yeah,
interesting. As a previous semi-pro hockey player myself, you're out there, you're playing for your country, and you got another country booing you. Now, I think the reality is regardless whatever side you're on, these are hockey players. They're
right.
playing a game, right? And so
Yeah,
that game actually started with three fights. So it just goes goes to show you that the fighting to me is not the solution in regards to the reality of Canada and the US going head to head. What I do think is happening right now is that Trump is setting the table for negotiation. And so that's where, if you read The Art of the Deal, is that he's looked at across the board and he sees that the US, in regards to how the US is being treated on a world stage on trade, they've actually been very generous. And so for him, his mandate is to help Americans. And so that's where, as a Canadian, he's you can see he's posturing that. And so I think on Canada's side, there's a lot of uncertainty, and whenever there's uncertainty, there's a lot of people that will say they do nothing because it's easier to do nothing. And so I think that's across the board right now with the new administration coming in. It's like, okay, let's just kind of wait and see what's going to happen. And so this is a big ship that the US has. And so they have 4 years to turn around the ship. But one thing that you can see, I think that's a lot different, John, than the first term, is that Trump is actioning faster than I think any other president in history in regards to taking massive action. He spent a lot of time before him actually stepping in to actually build the leadership team. And so he went and found all the leaders. And so from day one, you could see executive order, executive order. And so for me, this ship that would normally take, we'll say, a lot longer, I think it'll be a lot quicker that we'll start
yeah,
to see either some benefits or some negative traits. And I can say right now what they're finding in cutting and spending and is they're finding hundreds of millions and even billions of dollars right now. And so this is where, when it comes down to tariffs, I think that there's posturing. But
yeah,
then in regards to, say, inflation as well, I think that if their whole position is to cut as much costs as possible and then to allow we'll say, reduction in taxes that will actually help mitigate inflation from rising. And I think that's the big concern right now, is will
yeah.
inflation rise? And that's where you're seeing the treasuries right now. They've actually gone up a little bit, right?
That's right. Yeah, those treasuries have gone up because investors are basically saying, we take Trump at his word. Now, to be clear, I agree with you, and I think investors and sort of the economists agree that a lot of this is a negotiation tactic, right? And tariffs are important, and they need to be leveraged in certain moments. For example, I think about solar panels. China, their economic system has a lot of challenges, and if you look at their last 20 years, they've just dumped endless amounts of capital. I mean, they're just printing money, and they have this hyper finance model. And candidly, if you look at the numbers, it's not going to be a good next 20 years for China due to this. But I think about it because solar panels were a great example where they were selling solar panels below cost and importing them into the US, and it was just killing US manufacturers. So they imposed strong tariffs. and created a more level playing field. And so, trade is very complex, and our economic system is so complex. I mean, a widget could be made in one country, shipped to another, to be added to another widget, shipped to another, and then it goes on and on. It's like the idea a car takes 30,000 individual inputs to make, right? And so it's very complex. So the blanket tariff thing, I do think, is a negotiation play. And when you look at, say, for example, something like the cost of a new home, if those tariffs did come through, that 25% tariff with Canada on lumber, for example, and other materials, it would add about $29,000 to the cost of a new single family home. And we already have a huge housing crisis. So I think what you'll see is in that negotiation, it'll start to look a little more nuanced and will create balance there. And ultimately, once again, Canada probably has some things that, maybe some tariffs on the US would actually
Yeah.
help Canada, right? So, it's an interesting time because we are seeing a big shift in our economy and supply chains. And I think the pandemic sort of revealed issues within the supply chain, and is now accelerating things. So it feels like a lot's happening very quickly. But to your point, it's at the end of the day, Trump is trying to lower costs for Americans. So I would hope, and my belief is that it'll become a little more nuanced in the final negotiations. Um, and adding to that cost of a house, Mark, did you know that just from 2019 to 2024, the materials cost for a new construction builder went up 40%, right? So adding another 30,000, it'll just simply make homes unaffordable. So I think in the final analysis, once sort of the dust settles, you'll see a much more nuanced approach. The second factor are these deportations, right, that are being talked about. And today, immigrants make up 25.5% of the construction workforce. And I think what you're already seeing, right, it's making headlines and there's some negativity depending on, what news channel you're watching around it. But right now it seems very targeted. They're going after folks that, either are involved in crime or, have overstayed their welcome. And, it's not like they're rounding people up en masse. And gosh, our food system in the United States is 40% immigrant. And when I say that, that's legal and illegal, right? People coming over for temporary work visas. So, just rounding up 10 million people and throwing them out all at once would have major impacts on the US.
Mm.
So I think that's another thing where there's a little bit of, tough talk, but it'll become more nuanced in the actual execution. So those are the two things that I would say if you're going to put a concern around some of these policies, it would be around the tariffs and the immigration, just because they will have an impact on cost. Now, for operators like Faris Capital Partners, we've been well aware of this, right? And so smart operators are already thinking about this kind of stuff, right? So, where can we pre source materials? Can we source materials from the United States versus overseas? And then having a strong contingency budget built in on all of our capex, just so if there are fluctuating costs, we don't get caught flat-footed. So, those are I would say the two concerns that an investor should be watching around real estate. But it just goes back to with a good operator and a good mind, and like even going back to the immigration thing, right? Like when we rent to our residents, we're confirming valid, residency and all of those things, right? So we're not exposed within our portfolio. And to take it a step further, I was talking to Georgia, our senior VP of asset management, and we vet every resident. So there might be a primary leaseholder, but if another adult is staying in that unit, we also verify them. So, most operators are doing that. You will find some that aren't. Obviously, these illegal immigrants are living somewhere, right? But when you work with a reputable group like Ferris Capital Partners, we're already checking those boxes, right? We would have done that regardless of any potential, deportation strategy or plan, just because we run a tight ship and we're on the right side of the law, right? And so these things are already verified. So once again, most operators are doing that. And so, moving on, I would say to some of the things like, so we've talked about some potential concerns, some watch list items, if you will, remote work ending for federal employees. In fact, I was talking to a friend who's actually not a federal employee, but just works for a university here in Atlanta at Georgia Tech. And he's still remote, but, it's just, the trend is starting to turn a little bit where even companies are starting to say, hey, we want you back in the office at least a few days a week. And so that could provide some much needed relief for the commercial real estate sector that has been particularly challenged in the office space environment, right? And one thing that was interesting that the Trump administration did on day one is they started looking across their portfolio of federal buildings,
Hmm.
and there are a ton that are just sitting unused. They're,
Yeah,
outdated, in bad condition. And this could be everything from a post office that just is no longer in use to, an office building in Washington, D.C. And so they're starting the process to liquidate. And what they're doing, what's interesting, and you're not really hearing it in the news, is they're looking to developers to come in and maybe say take that old building and convert it into multifamily or some better use, right? Maybe office in that area, even with return to work, will still be challenged. So let's convert that into its highest and best use, which could be projects like multifamily housing. So I think combined with more people going back to the office, that'll help support the commercial real estate world. And then you add in some of those conversions, that'll provide some much needed relief for additional housing opportunities.
for sure. Yeah, no, all great insights, John, for sure. And a couple things I'll maybe elaborate on. When it comes down to you and I, we run a business. So if you're listening, you're a business owner, you know that there are certain key metrics that you track that are really important, right? Like EBITDA, so net profit, maybe your revenue, your overall expenses. They're important, right? And so this is something that the Trump administration will be graded on how well they're doing based on overall the everyday average American's expense, right?
Yeah.
And so one of the biggest expense they have is their housing payment, their mortgage payment. And so one of the things that Trump has talked about, I've heard him talk about for quite a while now, is he will push to get interest rates lowered. So I know it's not in he doesn't make that decision, the Fed does, but he will be putting a lot of pressure on bringing that down, which will lower costs significantly. Now, the thing with inflation, that's a big concern, but inflation comes from printing enormous amounts of money and going into debt. So what they're doing right now, they've made a mandate to cut spending. If the goal is to cut their deficit from 2 trillion to 1 trillion, so to cut it in half. And so why they're doing that is if they're cutting it down, it means they don't need to print as much money, right? And so if they're cutting it down and then from that cut, they actually do a overall tax cut for the everyday American, that means that they'll have more money in their pocket. And then if he can lower interest rates as well and put pressure on the Fed to bring down interest rates, they're going to have more money in their pocket and their overall expenses will come down significantly if interest rates come down as well. And so it's smart because everyday business guy like John, you and I, we'd look at, okay, we got to first lower our expenses on the things that maybe are not bringing any value to our clients,
That's
right?
right.
And so that's what they're doing first. And so they're being pretty aggressive on that. And so this is where time will tell, but their grade on how well they're going to be doing, on how well they've done, will be coming down to they're going to be looking at the inflation. You can bet that the media is going to be pushing that. If inflation starts going up, they're
Yes.
going to be on high alert. And so he knows in business, it's success or failure based on what the numbers are saying and based on the everyday expenses. If the everyday expense, goes up, you said 40%, was it, John? You had said?
40% for materials costs from 2019 to
Okay.
2024.
So if
Yeah,
expenses, and you see it at the grocery store over the last 4 years, like eggs, milk, everything has gone up. So if it keeps going on this trajectory, Trump is not going to be very popular, right?
that's
And
right.
so he's on mission there to make sure that's not going to be the case. And so, I, for me, what my numbers that I'm thinking, like I'm starting to, inflation, is something that is on the cusp of getting too high right now. So they're watching that, but like anything, it takes a little while to turn the ship. And so there are hardcore mode on bringing that down and get the tax rates cut as well to keep more money in the everyday American's pocket uh, at a higher amount. And I do think that moving forward, this is something that just from a straight business sense, these guys are going to be very driven to execute to bring down those numbers for the everyday American. And I think that's what they're going to be graded on ultimately.
Yeah, no doubt. 100% agree. And one final thing that we somewhat predict, right? And, what you do is you go and you look and see what are like the big institutional players doing. We've talked about it on other podcasts when they're leaning in, like whether that's single family rentals during the Great Recession. You're seeing it today with multifamily real estate. I'm talking about the world's largest private equity firms like Blackstone and BlackRock. So, we look at a variety of data points, but when you see those guys making moves, you pay attention, right? And so a lot of those groups are actually doing investments into Fannie and Freddie. Fannie Mae and Freddie Mac are pseudo government agencies. They're government sponsored entities, is the term. So GSE. So if you see GSE, that's what that means. And during the Great Recession in '08 and '09, they were having solvency issues. And so the government took more control. And so there's this thought that they're going to go back to privatizing Fannie and Freddie. The idea there is that, and we work with Fannie and Freddie, and, they do, I mean, pretty much any stabilized commercial real estate, particularly in multifamily, generally speaking, you're getting a loan from Fannie or Freddie. And it's largely a good process, but there's definitely inefficiencies. So by privatizing it, they could hopefully make it more efficient, move more quickly, respond faster to market insights or challenges, things that come up. There is a thought, though, because when things get privatized, that might drive up borrowing costs. But in a free market, and you see it happen all the
Mm.
time, that happens. But there are other debt providers in this space, right? So they'll get more competitive, and you'll start to see those costs drive. So that's something I'm looking at and excited for. I think that that absolutely makes sense. Why should the government be in the lending business? They may have some sort of oversight or be on the board or help kind of promote that. And the purpose behind Fannie and Freddie was to create more liquidity, right, and to make it easier for home buyers. Now, Fannie and Freddie also buys a lot of the secondary market. So you get your home mortgage from, say, Bank of America. It's probably sold into a portfolio of mortgages owned by Fannie and Freddie at some point. So that's part of what they do. So it is an absolutely, they're two critically important institutions, but that privatization move is something I would expect not, in the next few weeks or months, but probably in the next year or two, we'll see that start to move down the pike.
That might even lower. I'm, thinking about that. That could lower if you have somebody really strong that comes in and buys it and they run efficiencies. It'd be interesting if they were going toe to toe and they're competing at a higher level, and then they deregulate. I know, John, sometimes it takes a little a while when we're dealing with them, but it'd be interesting to see what would happen there. I mean, I see the case for increase in cost, but it'd be interesting to see. It could go the other way if you get a real strong buyer coming in from a
Yeah,
privatization standpoint, and then they implement a bunch of efficiencies. That'll be interesting to see that. But I'm sure it'll just
definitely one
get
to watch.
easier though. The deregulation part of it for operators, then we'll use them more often, right?
That's right. That's exactly right. So, that's really it. And I think, those are the big major changes we expect to see. So, as an investor, should you prepare, right? So, we are big believers in investing in real estate, whether with us or others. So, if you're open to a longer hold period, maybe exploring some opportunity zones could be good for you. For the investor, you actually do not pay taxes on that investment until year three. And by law, distributions have to begin in year three. So generally, what happens is those distributions you just sort of stick in an account, and then that's your tax liability. And then at year 10, when they exit the investment, all your gains are tax free. So it's definitely a unique model. You have to understand there's higher risk because you're in, areas that are a little, economically depressed, hence why the program exists. So it's not for everybody. Once again, a 10-year hold, but that could be something if you're in the US that you might want to consider. I think as operators, I've already touched on this, but just being thoughtful about your budgets, making sure you're accounting for potential price fluctuations that could occur temporarily. Because often what happens when new tariffs are implemented, for a great example, like we purchase a lot of lumber from Canada, and Canada subsidizes lumber. And so it's at a lower cost, hence why we like importing it in. Now, the US also subsidizes their lumber too. But, while that might cause some pain for Canadians over a long period of time, it could actually reduce costs here in the United States. But that could also free up more lumber that's needed in Canada. Because, by the way, Canada has a huge housing crisis and their costs are going up. So, it's one of these things where you can have that initial emotional reaction, but over time, as the dust settles, you learn that it may actually be a good thing for both the US and Canada. And bottom line is US and Canada, I mean, we're not just neighbors, we're like brothers, right? I mean, it's almost how I think about it. I mean,
Canada's
Canada
a
was
li
first.
Canada's a little brother, look at
Well,
and that's
I would,
that's like
yeah.
a 10x brother, and I think
Yeah,
that's good for the Canadian leadership is, again, going back to I could say this, I'm, Canadian and,
yeah,
down in the US and Florida, so I it I see both sides really well, but, when Canada's negotiating, it's really important to keep in mind that it's a 10x big brother. It's not like
yeah,
a 2x brother, like
yeah,
they're 10x bigger as well. And so I think from a negotiation, of course, there needs to be a win-win deal. And I
yeah.
think that any sort of negotiation, I think you can negotiate a win-win
That's right.
deal
And we
very
saw
well.
it, right? The initial conversation with Justin Trudeau, they walked away with a, "Hey, let's pause
Yeah,
for 30 days, and we'd like to see some more support at the border for, fentanyl." And, that stuff goes both ways
yeah, it
across the
does.
border, right?
Yeah,
And so, Mexico has some concerns, right? Here's the reality of Mexico. Did you know, like, nearly 100% of the weapons that the cartel uses are bought legally in the United States and brought across the border, right? So, there's just, to your point, there's got to be a little win-win here. We got to work together because these are real big challenges, whether it's fentanyl or illegal drugs or, illegal immigration. And I think it's in Mexico's, United States and Canada's interest to work together on these things. And it felt like that's what happened, right? And so walked away with some short-term solutions to kind of pause and reflect. And I think now the conversations once again will become more nuanced.
for sure. So yeah, moving ahead, it's like, okay, how do you prepare? So, John, you gave some good suggestions there as well. And to just build on that, moving forward, you have potential if inflation does happen, then what do you do? It's like you want to make sure that the anything that you can buy now, buy it. And I know, John, like we're doing that with our assets now. Like the we were just talking about the chandeliers. We pre-bought. Now we actually have them in a shipping container there so that they're ready to go. We got a really good deal. And so buying material now is a really good thing because with multifamily and apartment investing, even if inflation does go up, is like the multifamily space allows you to stay ahead even if it does go up. So rents will go up if inflation goes up. And so you're protected. And so I think that's just such a big thing moving forward. If you buy the deal at a good cost basis and you buy something that is cash flowing from day one, so it's already making money, right? You have adequate cash reserves, as John you referenced there earlier, and you make sure to whatever your debt is. So if it's fixed rates, like make sure that you lock it in for the business plan. I know, John, you and I, we like fixed rates just because
Yeah.
of how large these assets. If it goes up by 2%, you can be in trouble. And so we like that. But if you buy a good enough deal right now that has upside by executing a strong business plan, going in and renovating and bringing rents to market value, you're really, it's just keep focusing on the fundamentals. And I think every sort of pandemic issue that I saw in the past in real estate, been in the business for 18 years, but even studying going right back even longer than that, is that the investors that stuck with the fundamentals, that didn't get shaken, and scared into not acting, those are the ones that just stayed consistent and they just killed it. And they look like geniuses after. And so we're going through another time like this that, John, I think based on the fundamentals that we're seeing, based on the amount of housing deliveries that are actually getting absorbed in the market, and because there really hasn't been construction over the last couple of years from a lot of the new development, and we're seeing population growth in these markets that we're investing in, such as Tampa and we're in Charleston, and now we're going into Atlanta as well. These markets, there's population growth, but there hasn't been a lot of new deliveries. And so
Yeah.
we're coming into the bottom of the market. And so, John, I can't think of a better, we'll say, environment right now to invest. And that's like
Yeah.
the next 6 months. We've talked about this. Like we're going all in on this. And of course, we're buying smart, but we're starting to see deals come up at better cost basis right now where the deals are starting to make sense. And so I think this is one of the best. In my lifetime, I think this is one of the best times to invest in real estate. And it goes back to when it's not sexy to invest in real estate, that's when you really should be investing. And it's definitely one of those markets right now. It doesn't feel sexy to do it.
That's right. And I think, it's a point we've made numerous times, but one of the best hedges against inflation is real estate, right? So if you're concerned about inflation, real estate's a great place to put your money. And if you're not concerned about inflation, then, it's, equally good because at the end of the day, if you buy a deal today, like you said, cost bases are really strong today, and you don't see that increase in cost, you're going to have a much better outcome at the end of that investment. And I would also say it's another reason we like value add. Yes, we are renovating these units, but we do a lot with paint. We do a lot with just some new, inexpensive lighting, new hardware on the cabinets, and often assets we're looking at are new enough where they're really solid all wood cabinets, so we can paint versus replace. So there's a lot of things we can do to minimize those cost exposures because we're not going out and spending 50,000 a unit. We're spending 8 to 12,000 a unit, and so with a nice reserve in place and with some contingency, we can be covered should something increase meaningfully. But once again, we're not going in and putting in like, building a new apartment building. We're just renovating an existing unit. So, I think for me, it's just about being thoughtful and paying attention, but recognizing that in times of uncertainty, one of the best places to put your money is in real estate because we talked about it before. It's immovable. They're not making any more of it. And there will always be a strong demand, particularly in these key markets that we like to invest in that, as you mentioned, have strong population growth and economic demand drivers.
So well said, John. Always great chatting. And whenever it comes down to talking about politics there as well, I know you, you and I always had some good conversations on this. And I think this was really well done. At the end of the day, whatever side that you're on, I think it comes down to you got to make decisions from a business standpoint on how the administration that's coming in will impact your investment. And so, based on what's happening today, real estate, the fundamentals for real estate have never been stronger. So I really appreciate you guys listening to the show. If you did enjoy the show and you like investing in real estate, go to faircapitalpartners.com to see how we're partnering with investors like you to get 20% annual returns plus monthly cash flow with our team doing all the work as well. Thanks for tuning in to the Multifamily Investor Playbook. We love and believe in you guys. Keep dreaming and investing big.